Hello and a very warm welcome to Commodity Ki Pathshala, brought to you by NCDEX and Moneycontrol. Well, what we are talking about today is the steel futures on opportunities and risk management as a tool there. Steel futures, clearly, or steel prices for that matter, have been very volatile in the last 1 year. We've seen nearly 40% of gains come in for the steel prices, but the near term has seen even more surge come in for the steel prices. If you look at this week itself, we are up by nearly 10%. The latest surge clearly comes in on the back of Russia and Ukraine conflict. But even before that, because of the iron ore prices increasing, prices have been on a surge. And then it has been about the Chinese demand as well. So whichever way we look at, even as we move forward from here, there are expectations that as economies have started to open up, there is going to be that manufacturing and infrastructure demand coming back into the markets as well. What does it mean for the companies? What does it mean for the prices? And what does it mean for you as an investor or a hedger or a stakeholder is exactly what we will be discussing today. Joining me on this great panel is Mr. Arun Yadav. He's Senior VP NCDEX. We also have with us Mr. Dhruv Goyal. He is CEO Steel Mint. We also welcome Mr. Parikshit Bardeja. He is MD KL Concast Private Limited. And then we also have Mr. Navneet Damani. He is Senior VP and Head of Research Commodities and Currencies at Motilal Oswal Financial Services Limited. Gentlemen, hi, and thank you so much for joining us here today. And we live amidst difficult times, especially with commodities in focus. We've seen such a huge run up across board. Let me come to you, Mr. Goyal, first. How do you look at the global tension, congestions, and the kind of impact that it has had on the steel prices from where we stand?
Uh, Thanks a lot, and I welcome all the panelists. So, as most of you are aware that the prices have gone, very sharply in last 1 week, especially after the Russia-Ukraine war. And literally, people do not have any idea where will these prices stop. But yeah, when we, speak to people or when we try to get sense from the market, feels that these prices are little unsustainable in the longer run. But maybe short term, because of so much of uncertainty, prices may sustain for some time, at least till March.
Absolutely. Nobody is denying the fact that the volatility and the kind of price rise that we have seen could stay on for some more time. It's very difficult to tell you on where the markets are headed, where the prices are headed, etc. So we're not going there. What we do want to understand is that in this kind of a market, what are the fundamentals that you need to watch out for? And also, what is your sense on how you could hedge yourself against this volatility? This one is to you, Mr. Badeja. So when we look at the geopolitical tensions that we are dealing with right now, what is your sense on what is the kind of global or Indian demand and supply scenario that we are working with?
The Indian demand's been quite buoyant recently, and we expect it to remain buoyant. Now, with all these geopolitical tensions coming in, there could be a lot of changes. We don't know really what to expect right now because these are really uncertain times, and with the kind of price increases that we've seen, we would see certain pullbacks in terms of demand because everybody has certain budgets in mind, and when you exceed that budget, you'll obviously see flattening of the demand. So yes, it's very uncertain right now.
I absolutely understand that the way the equity markets are declining, but there have been some spots of some pockets of gains, and metals clearly continues to stand tall among all of that there. Navneet, this one is to you, and we keep chatting commodities with you. What is your sense on when you look at the ferrous metals, when you look at the steel prices, and we do understand that 11% of global steel comes in from Russia, 6% of that comes in from Ukraine. So the kind of position that we are in right now in the global markets, what is your sense on what fundamentals are going to be more important going forward? As Mr. Badeja said, until at least March, this uncertainty will stay on. What's your sense? What are you making of all of this?
Well, Manishaji, as the other gentlemen have pointed, the prices have been overheated, and 10 to 12% move in the last 2-3 days, 5 days maybe is a little overstretched. I strongly believe that India is the second largest player of steel, and we are not largely dependent on the global macros as to how the steel demand is on the domestic front. But largely speaking, globally there is now going to be a glut, and that is what is impacting the markets. And you've seen the crude oil prices, steel prices, and these ferrous and non-ferrous prices shooting off the roof. So I believe that this short-term phenomena is likely to keep driving the prices higher. But from a medium-term perspective, I'm still very skeptical whether these prices are likely to hold or not. And talking about from a short-term tactical point of view, until the things settle out, I think prices are likely to be buoyant, and we've seen nickel prices gaining by about 150%. And there is no proper substitute for steel at this point in time. So this kind of volatility is likely to continue probably for this month as well.
All right, so difficult and uncertain times, as everybody's told us. Arun, what's your sense? I mean, we've seen a product where you can hedge steel volatility into the markets. How have you seen that happen? And what would you advise stakeholders, investors, traders on how to make use of this?
Yeah, hi, good evening, everyone. So I think the way steel has moved, it is not it is not only about steel. If you look at the entire commodity market during last 2 years, during the COVID time, whether it is agriculture commodities, non-agriculture commodities, we have seen a bull run across the commodities. Now, if especially if we talk about steel, I think China is the biggest producer, India is the second biggest producer, and if we look at the domestic market also, we will feel that at times we follow China, at times we are kind of lagging behind them, or we are trailing them in terms of prices. At times we have our domestic factors which have a larger role in terms of driving the prices. Having said that, I think the important part is that how can we manage this risk? Because if you look at the prices, and you have also talked about it in the beginning of your show, and all the panelists have talked about it, is that since the beginning of the pandemic, the prices of steel have almost doubled, right? So from somewhere around 26,000 rupees per ton to now around 56,000 to 27, 28,000 rupees per ton to now around 56,000 rupees per ton. So the prices have almost doubled in last approximately 2 years, right? Now think about the infrastructure companies, right, who have to, who have a long-term contract, and they want to nobody probably think of that kind of rally in the prices. Now how can they manage their prices? That is the big question, and I think that is where the futures contract come into play, right? You at least have some medium to hedge your price risk, and I think that is what is required today. And it is not only about the final consumer, the infrastructure companies. It is also about somebody who is importing scrap. So I think the contract that we have right now is a semi-finished product, and it kind of help both the both the downstream and the upstream players. So whether it is a scrap player or it is a the infrastructure player, both can manage their price risk using the steel contract that we have. In fact, when we talk about the correlations, we have seen that the correlations with different different uh, part of steel value chain, we have seen the correlation, and we have seen that the TMT, which is a product produced from the billet and ingot product that we have, it has around 80% correlation with the steel futures contract. Similarly, you talk about scrap, you talk about that has almost 90% correlation. The sponge also have a very solid correlation. Talk about wire rod, which is again upstream product, that also have 80 to 90% correlation. So I think whatever part of value chain you are, definitely this contract offers a very good opportunity to you to kind of hedge your risk. And I think in such a volatile environment, volatile times, you never know what will happen in the geopolitics today, tomorrow, right? Nobody probably would have predicted the way things have turned up in last 1 week, and the way the prices have gone up. You look at any commodity, right? We are talking about steel, but you look at crude oil, what has happened there. So I think the prices are going to remain volatile, and it is difficult to guess which way the prices are going to move. And we are not talking about 10% movement. The movement can be as sharp. We have seen the prices going up by as high as 12,000 rupees in last 1.5 months. If you talk about steel, so the volatility is going to remain huge, and I think the market participant definitely require a tool to hedge their price risk. And I think luckily we have a contract that offers them that kind of a protection.
Oh, absolutely. And one should be making use of that as well. Dhruv, this one is to you. So, when we talk about the global markets, and as was rightly pointed out by Arun as well, that while the geopolitical conflict is very recent, we already have been talking about the climate change and how China has been trying to cut on steel production as well, keeping it as much as last year or even bringing it down slightly lower. How are you reading these various signs, the climate change, the steel production, and how do you see it impacting this commodity? Dhruv, are you on mute? We can't hear you.
Oh, I'm sorry. So I'm saying that decarbonization is still, it has become a very big issue in China and other developed countries. In India, it is yet to pick the momentum. But definitely 10 years down the line, India will not be immune with the decarbonization issue. Companies have to adhere with the carbon norms. And looking at the current scenario, yes, China is taking steps to cut down their carbon emissions. These steps are in various contexts. They are changing their feed mix, or they are cutting down the old capacities. They are bringing more efficient capacities. They are, switching from blast furnaces to electric arc furnaces, wherein the carbon emission is lower. Yeah, so I think this will definitely make structural changes in the commodities market, in the steel market, and since China is the largest steel producer, the impact will be seen all across the globe, and especially after this, geopolitical tension, we see a structural change in the trade dynamics, whether it is domestic or the global market.
Oh, yes, world is changing as we know it and changing in so many different ways. Mr. Badeja, this one is to you. As has been mentioned, all raw material prices have been increasing. Crude at $120. We've seen coal prices all-time highs. Aluminum is at record highs. We've seen nickel, iron ore, zinc, lead. All of these prices run up quite strongly. So when we talk about steel and then talk about the energy costs and price volatility, would you say it's becoming a difficult time, even if it is short lived? We don't know how longer this is going to be. Markets are reading it as a phase. But how does a person like you perceive this market? How do you think is the best way to hedge these kind of markets?
With raw material costs, like, as you know, in just the last few days because of the war. Oh, sorry, can you hear me?
Yes, we can. We can hear you.
Okay. So, just for example, coal prices have shot up through the roof, like from $230 a few days back, and today was trading at 430, $440. So with such jumps, it's really hard to imagine what's going to come. But the best way is to hedge. If you have a platform like NCDEX where you can hedge now. I was talking to a customer of mine. We make steel castings for machinery parts. So it goes into the cement sector, in the sponge iron sector, and various other sectors. Their orders are, it takes 3 years, 2 years to for their orders to fulfill. So people like them, I suggest that they hedge with steel because a big chunk of their cost is steel, and yeah, that's the best way you really need to hedge right now.
Navneet, when we talk about hedging here, what's your sense? While, of course, if you look at it vis-a-vis the base metals, how much of an hedging do we see in steel? What are the numbers, and how much should we really need to do? Because steel, in that sense, is more intrinsic than we see as compared to other base metals.
Well, Manisha, the major problem with steel we faced is the contracts were not very liquid over the last few years. Both the exchanges have time and again launched steel contracts, but they have not been as successful as the ferrous complex, non-ferrous complex. We do very active trading for corporates and very active hedging solutions for corporates. And not only domestically but internationally, also a lot of corporates hedge with us. But we strongly believe that steel, being a domestic market where price mechanism is derived in India, we still didn't have a very good platform where one could have hedged. A lot of clients were doing a lot of proxy hedges, but that did not give them the exact quantum of hedge which the actual steel contract would have given them. So now that this steel long contract is available on NCDEX, and we are seeing decent liquidity and volumes come in, and we expect that with the delivery mechanism now being in place, there could be some sizable business and a proper hedging solution which is available to customers who are on the ferrous side of the business. It's a very important aspect, as Bhartiya ji mentioned, that these contracts run up to 1 2 years, and if you don't have a proper mechanism to hedge your product, then it clearly goes for a toss. Like we've seen the prices almost doubling from where they were during the times of pandemic, and a 15-20% rise in the last 1 month of course takes a big hit on the kind of margins that you garner. So a proper hedging solutions, along with that a proper hedging mechanism like the one NCDEX is providing is required, and I think it's a very good opportunity where one could look at garnering and scaling up their business.
Dhruv, how do you see it? I mean, taking a lead from what Navneet just said, India is the second largest market when it comes to steel, and even then, the hedging practices are not so strong within the country even now. And there is finally a contract that you can make use of, and there are corporates who would want to make use of it as well, because steel, as we've been saying, is intrinsic. It's a raw material for various other corporates and for manufacturing units, etc. One, what is the number that we could be looking for when it comes to the Indian markets? And two, what is the kind of steel hedging or steel trading that we see in the international markets? What is the best and most liquid contract if you had to watch one for the international space?
So yeah, I think futures or hedging is very popular in developed countries like Europe, wherein LME is there. China is very liquid, and I know when we speak to our clients there, so most of their transactions or their hedging takes place on the Shanghai Future Exchange, wherein they have one of the most liquid contracts for both rebar and hot rolled coil. But only challenge I personally feel with Indian market is, there are two types of manufacturers. One are very large, one are mid-size and small manufacturers. So maybe the quality, even from NCDEX or any other exchanges point of view, when they have to come to delivery point, so their specification may not be, many times may not be met by the smaller players. So I think this could be one challenge which Indian market may face. But I'm sure that as time comes and people becomes more quality conscious, wherein NCDEX will also be confident of getting quality delivery as per the contract guidelines, this should pick up.
That is the one thing with steel, because there are just so many types of steel and so many types of steel traded and imported and exported and used as well. Arun, what's your sense? What was the choice of long steel contracts when you went ahead with it? What is the market feedback on it? And as Dhruv has mentioned also, that there is two big players and then there are small players as well. How are you finding that balance between the two?
So Manisha, the contract that NCDEX offers right now is a semi-finished product. So basically, we are offering ingot and billet contract. Now, when you trade in ingot and billet contract, I think it kind of gives the access of hedging to the entire value chain, because the ingot and billet prices are usually referred as a benchmark prices for the entire industry, and then the calculations are done based on that. So suppose I want to import scrap, so probably the calculation will go that ingot minus XYZ rupees, right? Similarly, if I have to talk about TMT, the calculation will go that ingot or billet, for example, billet plus this much rupees per ton. So that become a reference, right? So when you have the reference contract and when you have a solid correlation between the reference contract and the other upstream and downstream contract, I think you can definitely hedge, because when you hedge in the underlying contract, you need to have a very good correlation, and that is something which is present here. So if you suppose you use the billet contract that we have, as I mentioned earlier also, that it has almost around 80% correlation with the TMT, which is a finished product. It has almost 90% correlation with the wire rod, and which is again a finished product, and around again 90% correlation with the scrap. So which is your the initial product. So I think the entire value chain can utilize this product, and that is why we choose this product. One more thing I would like to add about the quality aspect. So I think yes, there is definitely a big difference in the quality that is being produced by the primary producer and the secondary producer. One reason why we went with the long product is definitely because around 60% of the total production of a long product comes from the secondary producers, and they it's not, I mean, it is branded, but it doesn't command the same kind of brand which the bigger producer or the primary producer kind of command in the market. So there is a different kind of a market for it. Secondly, if you look at the entire production, So out of 110 million ton of production in the country, I would say that we are getting at least to the 50 million ton, because it is around, say, 40% of the total production, the long products. So that's the that's the total size of the commodity. Additionally, I think one of the panelists talked about the quality thing. So I would just like to bring here that the quality that right now the exchanges are adhering to is the BIS quality. So we accept BIS 2830 and BIS 2831 grades, which are the commonly referred grade in the physical market for billet and ingots. So in that way, I think, yeah, quality definitely was an issue 10 years back when the market was transiting from a non-BIS grade to the BIS grade. But over a period of time, BIS grades have become very prevalent in the market, and there is definitely a market for the BIS grade. And that is why we also took a step to kind of relaunch this product after a period of around 7-8 years. So I think now the quality point, I think people can refer to the BIS grade, and based on that, they can definitely trade, and the quality that they will get from the exchange or they have to deliver on the exchange will be a BIS grade quality. So that's how we have structured this contract, Manisha.
Well, that makes sense. And yes, when we talk about the commodity markets in India, we still are a younger market here, but there have been lots of learnings. And we do hope that this steel contract fulfills all the requirements that the industry perhaps has been looking for when it comes to hedging. Mr. Badeja, this one is to you. So while we have seen the steel price continue to run up, has it also led to more work, more better margins for the steel industry? The price rise clearly has been too much in a very short time. How have you as an industry witnessed this?
With terms to our profit margins, we are able to pass on the price rise, but only slowly and steadily. We do have contracts, we do have short-term contracts, but the future ones we are able to pass it on. But if to say that the margins have increased to that level, no, I wouldn't agree to that. But it does. We do get to the same margins or maybe more in a period of time. So if this cycle is extended for a bit longer, then we would be able to pass on the prices.
Okay. Mr. Badeja, also then, how would you look at the steel futures as a company? Do you see it as a great hedging mechanism? I mean, as you said, the price movement has been too much, too volatile, too uncertain, and it really hasn't led to increase in margins of the industry as well. How do you look at the hedging mechanism then?
Hedging is a really good tool. If you see, in times to come, I feel that India is going to be a very big steel market, and it's going to be a very big export market as well. So slowly you'll have a lot of players coming in for exports, as in you'll have a lot of trading houses which will be wanting to buy material from India. And I see that happening now, and I see that increasing in the future. So because export deals are big deals, and if you could hedge that, it's the best way, and it really makes sense, especially in terms of larger contracts and longer contracts.
Mr. Badeja, I know you have to leave slightly early, so let me get a couple of questions out of the way with you first before we let you go. I also want to know, a lot of us are looking at these geopolitical tensions, and none of us really thought that we will see a pandemic, first of all, and then a war at this scale coming in. I mean, it's a world that we really haven't seen. I haven't seen in my lifetime, but I do speak to a lot of people, and they also suggest that, yeah, this is a very difficult time. Geopolitics, we've seen that before, but at the scale, at the kind of sanctions that we are seeing right now, and the kind of impact that it has had on commodities, how are you reading the current situation?
How do I deal with it? Well, the company, of course, with the price rise, I think the buyers, the sellers, they're all in the same boat. And as I said, we are able to pass on the prices because steel is something that it can easily be passed on. But it's more difficult for people who make products out of steel. For them, it's an issue. For a steel manufacturer, it's easier for them to pass on the prices.
Mr. Bereja, also, the kind of market that we are in, where we don't know what's happening tomorrow, what kind of sanctions are coming, how is it going to impact the global trade, for that matter. The next phenomena, which is natural and which we are seeing starting to play right now, is that people are now building their inventories. People are, in some sense, hoarding some of these raw materials and commodities as well. What is your sense? What is the next step? How would you perceive this market going forward now? How are you preparing yourself as a company? What are you readying for yourself now for?
See, in terms of prices, with the way coal has run up, doubled in 2 days, so I don't see the prices coming down really soon unless, and with the sanctions on Russia, they're going to stay. It's just not going to go away in a month or 2 months. So I think it's going to take some time for this to really play out.
And so, how are you working around this then? What are you doing to ensure that it doesn't disturb your business too much?
Um, as I said, for a steel manufacturer, it's just, it's very difficult. You really have to get as much inventory as you can, as much stock, more raw material as much as you can. But that's not possible for everyone, and that's not what everyone can do. Right now, the best way is to just you can hedging is a good tool right now, because if you're buying a lot of inventory or raw materials, you can hedge it on NCDEX or some other platform like that, and you're safe from your bets. So that way, that's right now it's a perfect time to actually hedge it.
Well, absolutely. Navneet, would you agree to that? I mean, would you second that? Because this is a time that when people are buying, ensuring that they have enough inventories, ensuring that they don't have to shut their businesses if this goes longer than what they are prepared for. And an exchange is a better way to hedge it, even buy it on that platform.
Well, definitely, exchange is going to provide a platform where you can look at hedging, but the kind of run up we have seen, I would rather warrant for a 10, 12, 15% correction before any meaningful upside here. And going aggressively long at this point could be little critical. Of course, you don't know how things are going to pan up in the next 5, 7 days, what kinds of sanctions are being levied. But let me tell you that domestic steel prices are not. India is a benchmark for the steel prices, and every country which trades steel has their own benchmark prices. Like you have for the non-ferrous space, LME is the benchmark price, and Indian prices are just the price takers. But in case of steel, Chinese steel prices or European steel prices do not drive the domestic steel prices. So what we are seeing here is a little artificially carried on bullishness, or probably built into the prices. And my sense is that this cool off could come in anytime soon. Once we see a reversal in the input cost, like if we see a cool off in the electricity prices, or if we see a cool off in the crude oil prices, then definitely these prices are not likely to stay here and could start to cool off over the next few weeks. So if you want to hedge, wait for a better level. Here going aggressively long could be a little critical from my understanding.
Oh, absolutely. Dhruv, this one is to you. So, when we look at the prices moving higher, as we've been saying, that the only sector that has done well in the equity markets also has been metals. A performance by far the best as compared to various other sectors there. So, when you look at steel and when you look at steel companies or steel shares for that matter, how have you seen that correlation work? And would you say that underlying commodity and the related stocks, how have you seen the performance?
You're right that steel companies has seen a very bull run in last 2 years, and there are several reasons for that. One is that as you mentioned earlier, that China's they are cutting down their capacities. Their intent is to cut down their exports so that they can control carbon emissions, and that has benefited India to a very large extent. And India has become a net exporter in last 2 years, and yeah, so this is one reason that has helped Indian companies, because the market dynamics have changed. Second, because the domestic demand is so good that the companies have been able to sell at a have been able to sell in the domestic market as well. So yeah, I think these are the two key factors that has held companies as well as their share prices.
So, what would you say, Dhruv? Is it better to buy the underlying commodity, or is it as an investor, or is it better to buy the stock?
I think it is better to buy the stock, as Navneet mentioned, that not the right time to take long position, because these prices are more sentimentally driven rather than the fundamentals. And in there's any news or any increase in supply will pull down the prices very sharply. So I think it makes sense to bet on share prices rather than the underlying commodity.
We've also had instances, Dhruv, where people say that when you're buying the share, you also should perhaps hedge that share with the underlying commodity. How do you see, that kind of a formula work?
I'm not very sure, but Arun can explain on this. How is there any correlation between the NCDEX prices and the share prices of any steel company?
Arun, it's basically come to you then.
So we haven't done a very detailed study, but of course, Manisha, you have also mentioned that over a period of couple of months or last 2 years, we have seen that the metal stocks have performed very well, and probably there is some correlation. I do not have a number right now to kind of talk about that number. Another question that you have asked, whether somebody should invest into the stock or into the underlying commodity. I think it depends on the type of investor, because different investors have different kind of a risk appetite, and so based on their risk appetite, I think they can definitely look at one of the sector. I mean, it is not again, because the company share is not only about the prices of that commodity. There are a lot many things that goes into buying that particular stock. So then you are exposing yourself to all those kind of challenges. But if you are, say, bullish or bearish, or you have any opinion on the prices of a commodity, I think you should definitely go and trade in the underlying commodity. That is my personal view. But because when you trade into a stock, you kind of expose yourself to a other than the prices of the commodity, you expose yourself to a lot of different things, whether it is the management, or there are a lot of things which comes into play. So again, then you are not only taking a bet, or you are not only trading basis the underlying commodity, you are also trading into different things. So when your call is entirely on the prices of the underlying, I think it is better to go with the underlying. And when you kind of want to expose in additional factors also, you can definitely go with the stock. But I think it is again a very very personal thing, that which way somebody want to invest into. It is very very personal, and I think depending on the risk appetite type of the investor, I think it will vary.
All right. We will take the disclaimer in, Arun. But let me come to you, Dhruv, yet again. And Mr. Badeja made a very interesting point when he said that, yes, the prices are going higher and the inventories are lower and there's just so much uncertainty. But even with the price rise, it's not that the company's margins have improved anymore. And he also said that this is the best time as ever if you wanted to start hedging or start investing in case of the underlying commodity itself. How have you seen that happen? The kind of scenario that we are in, so much uncertainty, and even with the higher prices, the producers not making money.
I think there's one thing which we should look into, especially from the secondaries steel point of view, which contributes around 50% of India's total steel production. So price rise is not good for them, because as the price rises increases, their working capital increases, and steel is under the negative sector for banks. So getting working capital or getting finance for these, for their day-to-day purchases and sales is very difficult for any small mid-sized companies. And as in their working capital squeezes, their production also gets impacted. So yeah, I think this is something, as Mr. Bardeja mentioned, that good time, but at the same time, the production also gets impacted because of higher prices, because of higher requirement of working capital.
Also, Dhruv, when you look at the global markets right now, the other thing or the theme that's playing out is that while Russia and Ukraine may not be able to, put out or contribute much to the global trade, the other countries who are good in those commodities perhaps stand to benefit. And when it comes to steel, India does stand to benefit there. So there's an export opportunity also arising here. How do you look at that opportunity? And would you say that is yet another reason for that stakeholder to start hedging into the markets?
Yes, I think there are new opportunities that will come, especially the trade dynamics that will change after this war. But still, we need to get more clarity. There are news that probably Russian material will get exported to China, and companies which China was exporting to. So there will be a complete rehaul of the global trade. But yeah, from Indian context, I think it is Indian mills are probably in one of the best. They are seeing one of their best time, and also the exchange, as we mentioned that it is the exchanges. The future contracts are very popular in China. Most of the trades are taking place on these commodity exchanges, and India, since is the second largest steel producer, and it'll time will not be far that the activities or the liquidity on these exchanges will pick up.
Okay. So, for the advantage of people who want to invest in steel or start trading into steel contract, Navneet, what is your sense? Because one, there are two themes basically playing right now. One is the infrastructure demand, which the year started with huge expectations. How does that seem to be moving forward? And the other big theme this year is going to be the Fed rate hike, where we are hearing a lot about on how the US Fed will react when it meets in the month of March. How are you looking at both of these scenarios playing out for steel as an industry?
Well, starting with the first point, our country. Let me give some data points. In 2008, we used to produce somewhere close to about 75 million tons of steel, and now currently we produce around 142 million tons of steel. And by 2030, it is expected that we will produce around 300 million tons of steel. That is almost double of what we will produce. So, of course, there is a growing demand for steel, and the consumption is also on the rise. Infrastructure demand has been very robust, and it is more robust than what we've seen in the levels of 2013 to 2020. Automobile demand is also very strong, so both these are the require a massive amount of steel, and that is where we see that the steel prices are kind of holding where they are because the demand continues to be robust. Also, housing sector has seen a very big turnaround, which also contributes largely to the demand for steel, and that is likely to add further to the impetus. As well as I believe that in the short run, this hedging platform will provide some producers to come here and start hedging, as it was a need of the hour for quite some time. And since prices have run up so sharply, and long-term contractual obligations have gone for a toss, and if they don't start to hedge, or probably don't have a proper hedging mechanism in place, it is going to be difficult to meet their contracts. So I believe that it was a long due solution. Now finally NCDEX has found the solution, and if delivery starts to happen very smoothly, seamlessly, as it is happening in other contracts on the agro and the metals fronts, then this contract is likely to get a good thumbs up from the steel manufacturing industry and the consumption industry as well.
All right, we look forward to that too. But there's a third theme as well, and this one I want to throw at you, Dhruv. Environmental concerns, and is the reason that China started to curb on its production. Going forward, when it comes to more environment friendly as a sector, or even as a sector which perhaps would be looking at a development index, if we can call it that. How do you see the steel's journey from here on?
You're right. As I said, that decarbonization has become a very big issue globally. Although India, the thing will pick up. At least it will take 10 years for India to adopt or to adhere to carbonization, because India's steel demand is very high, and they cannot immediately switch to technologies which are very efficient and green technologies, because it will be very expensive for them to make steel. Uh, yeah, so I think globally things are changing very fast. As I mentioned, that there are two ways, and there are different ways companies are trying to address this issue. One is they are setting up new furnaces which are more efficient. Hydrogen is another fuel which people are exploring. Third is changing their processes, and fourth is changing their feedstock. So more and more companies are willing to feed more scrap as a feedstock rather than iron ore and coking coal. So these are the structural changes that are taking place not only in India, but not only in China, but all across the world. Just to give a reference, for example, the Tata Steel, they have also increased their scrap at their Jamshedpur plant, and since the plant is located in the city and their compliance for carbon emissions are higher, so they have to compulsory increase. They have to increase the feedstock to make sure that carbon emissions are not that high. But I'm sure that other companies are also trying to adopt the same policy.
All right. Well, that is the fundamental of the steel as an industry there, and we have a lot of audience questions coming in as well. And I'll start taking this. This one is to you, Navneet, and it fits just right. And this is Vivek Chopra asking, which is the best broker for NCDX when you want to trade steel?
Well, I represent Motilal Oswal, so it's a difficult question to answer. But let me tell you, we are very active on the hedging solutions and hedging part for ferrous, non-ferrous, and other side of the business. So if you want, you can connect to any of the advisors at Motilal Oswal, and they'll be happy to help you.
All right. That was a very, very expected answer, but let's, even then we got that way. Another is one from Mr. Harish Hari. He's asking on how does the steel help the economy? Dhruv, do you want to take that on?
So it has direct and indirect correlation on the economy because it's a capital intensive business, so it requires a lot of workforce, so it generates employment. Also, infrastructure is the basic raw material to build your infrastructure. So yeah, I think in term, both directly and indirectly, it helps in the economic development.
Navneet, do you want to take this one? This is from Nehal Patel, who's asking on why are the steel prices increasing the way they are?
Well, steel has a lot of input cost, which is kind of crude oil prices, which is adding to the steel price base. Along with that, the demand has been very robust, and as I previously added, that infrastructure development, automobile demand is where the steel price is giving the fresh impetus. So I strongly believe that once the risk premium which is built into the prices over the last 10-15 days once starts to fade off, you will see a cool off. But definitely we won't see prices where we saw during the pandemic of 25-26,000. We will stay afloat of about 35-37,000 or higher for the next couple of years or so. And I will not be surprised that if there is any loss of production or if there is any delay in production, then the prices could start to garner steam once again. So overall bias is pretty bullish, but the extra steam or the extra froth over the last few days needs to be cooled off.
All right, that's the answer there. And I have another very interesting one, and this one is from Mahendra Sutar. He wants to know on what commodities are traded on NCDX as of today. Arun, you want to take that on?
Yeah, Manisha, sure. So I think NCDEX, we have predominantly presence into the agri side. Within agri, we have commodities like guar seed, guar gum, castor seed. Spices, we have jeera, dhania, and turmeric. Uh, at this point of time, although they are not available, but we do had contract into oil seeds also, in pulses also. And in fact, since you have asked, recently we have also introduced the next level of product, which is your indices and options. So we have options trading also, which is available into few of the commodities like guar seed and guar gum. We also have an index, which is guarex, which is your uh, which is basically just like any other index into sectoral index into the equities market. So when you invest into the index, you basically invest into the underlying commodities. A proportion of your investment goes into both the underlying commodities or whatever is the underlying commodities. So I think these are broadly the commodities that we have. We also have commodities into the cotton complex. We have a past contract which is pretty liquid. We also have cotton seed oil cake contract which is pretty liquid. So if you are anyways associated with the agri commodities, or if you anyways want to associate yourself with the agri commodities, we have almost all the contracts into that side of the value chain. And we are talking about steel. So recently we have introduced the steel contract also. And as if you talk about steel, this is the largest metal. Steel is on the one side. If you talk about the metals, and the rest of the metals are on the other side. So that is the size of this commodity. So I think these are all the contracts that are available. Almost 20 odds commodities uh, which we have a futures contract on, and then around 4 or 5 where we have a future where we have options contract, and then we have one indices, which is the Guarex. So
Okay. So, Mr. Star, we hope that answered your question. And there are plenty of commodities to trade on, hedge on as well. And the latest one clearly in the list is steel there. I'll take another one. And this one is from Mr. Mohammad Ayub, who's asking on what are the challenges for iron and steel industry from here. Navneet, you want to take that on?
I think Mr. Dhruv will be a better person to ask this
Okay.
because he's part of the industry. So I think he should take up this question.
Um, Yeah, as far as challenges are concerned, I think say working capital in today's context, working capital is one of the major challenges that will be faced that is being faced by especially the smaller companies. I'm sure that the situation will be similar with the larger companies, bigger companies also. Such high fluctuation is again a big challenge because it is very difficult for any steel company, big or small. It is very difficult for them to whether buy material or hold their purchases or stock their material. So such high volatility is also it is a very big challenge for the steel industry. Otherwise, I think more than challenges from Indian context, there are more opportunities. As markets open up for exports. Also, domestic demand should remain robust for next 4 5 years. So it seems that if you see the maximum growth in terms of capacity expansion is taking place in India. So I think India is in the most bright spot and more opportunities than challenges.
Okay. There's another question, Dhruv, and if you want to answer this as well,
Yeah.
because this seems an extension of what you just said, and this one is from Mr. Ajit Singh. He's asking on why are the steel stocks falling? So,
Sorry, Manisha, I missed your question. Why are steel stocks falling?
why are steel stocks falling? So, I think this is something that Mr. Bareja also mentioned that even as the steel prices are going higher, doesn't really mean that the steel stocks will continue to gain because the margins are not improving, and that is, I mean, as you mentioned, the working capital is one part of it. But
Yeah.
how would you tell Mr. Singh, the exact answer
So,
for this?
so just to clarify, steel stock, you mean steel shares or
Shares.
steel physical
Yeah.
shares? Okay. So I'm not very sure what the reason is, but I'm sure people see little uncertainty in the steel market.
Sure.
Rising raw material prices. Prices may be higher, but margins may not be that high. So probably that could be one reason why steel stocks are falling. But definitely companies which have energy is a very big crisis all across the world. So any product which is power intensive, for example, ferroalloys, aluminium. So and companies which have their own captive mines and power plant, definitely they will benefit from this situation, and these companies should do good. But also companies which do not have access to raw material and they're dependent on market, they probably their share may be falling, but companies with their own supplies should be in the right place.
Okay, there are plenty of questions that we have from audience today, but I think it majorly revolves around on why, what affects the steel industry and why are certain price changes happening. And then, of course, this is very, very related to prices, which we don't really talk on our webinars here. We do not give price information or price forecast here. But, as we wrap this, and thank you, participants, so much for asking all of those questions. There is one wrap-up comment that I would want from all of you, and that really is the theme of our discussion today as well. And why don't you go first, Navneet? When you look at steel, when you look at steel industry, and when you look at the hedging mechanism, what are the kind of opportunities that you see opening up for the traders or the stakeholders with this one?
Well, I belong to the broking fraternity, and for the last 14, 15 years, I've been tracking non-ferrous for a very active as a very active analyst. But there was a proper mechanism if you want to hedge anything like copper or nickel or aluminium, and LME being the benchmark, you had a proper mechanism here. Steel, time and again, it has been launched and it has not been very very favorable. Either sometimes it has been a delivery mechanism which has been a problem, or volume or liquidity which has been a problem. I think it is high time that the kind of volatility and domestic product was requiring a platform which NCDEX has started, and if there are successful deliveries happening, and successful volumes happening on the exchange, and there is bound to we are bound to see some participants, because I believe that a lot of our clients wanted to hedge steel, but there was not a mechanism. They did proxy hedging through zinc, through nickel, through crude oil in certain ways, and it was not a very great proxy hedge. It did not kind of suffice the need or requirement which they had. So once you have a proper product which can give you upward of 75-80% kind of correlation, then definitely it's a win-win situation for both the exchange as well as the client. And I think this time around we'll be more successful than what we've seen in the past as far as steel hedging or probably trading on the exchange goes.
Drew, what is your sense, your final comments when you look at the steel futures? How do you see the opportunities here for a risk management tool?
I think from Indian context, it is still a maturing market, and I'm very confident that it will pick up. As I said, that China, most of the trades are taking place on futures contract, and it is inevitable because there's so much of price fluctuation, so people have to hedge their positions. As Navneet mentioned, that contracts should have liquidity volumes. So I think if NCDEX is able to maintain these two important parameters, I think it should be very successful contract.
Arun, as you've heard from both the participants and Mr. Vadeja earlier as well, that there is a need for that kind of a contract, and it has been tried and retried into the markets, but no better time than right now. And how, as an exchange, are you looking at this product? What has been the feedback? What is your sense on? Will you be able to correct all the things that did not work earlier and ensure that this one works well?
So, Manisha, I think the feedback has been very positive as of now. We have, as mentioned by other panelists, also there has been a need of this product, and we have been approached by a lot of the users of the product, a lot of infrastructure company, the construction company. They have approached us to kind of start hedging into this product, because all these long-term contracts cannot be, you cannot honor them without taking a hit if you do not have a hedging platform or hedging mechanism. So I think definitely this time the feedback, the kind of response that we are getting is way better than what it was, say, 5-10 years back. One reason being the prices are very volatile this time. In last couple of months, we have seen the volatility hitting as high as 25% plus. So I think that definitely is one of the reasons. And gradually, as any economy grow, hedging becomes a need. The market also learns about it. So I think gradually, if you look at the Chinese market, they have developed like anything in the last 10-15 years. They were at the same stage where we are right now. If you look at the entire commodity market, and in the last 15 years, they have just grown like anything. So I think we are at that stage. Slowly, the market participants are also understanding the need of hedging. So I think we have a need of hedging. We have a platform. So I think it is only about when do we start? And I think that the time is this is the best time to start hedging, because the kind of uncertainty that is there in the market, and as the other panelists have also mentioned, that it is not fully driven by the fundamental. There is a aspect of geopolitics also into it. You don't know what will happen tomorrow. And you started the session with saying that you and maybe all the panelists, we have never lived in so much uncertainty, the period of such high uncertainty. So I think it is when there is uncertainty, I think the need of hedging grows like anything. So the platform is available. I think my suggestion to the market participant would definitely be that you can definitely explore it as one of the avenue. Once you start doing it, I think you will understand why it is all the more important. So I think we have learned from the earlier instances also, and we also understand that the contract that we are offering this time is much better than what we have any time offered earlier. So in that sense, I think this is the right time, and we have the platform. So it is only about to kind of start using the platform.
Well, absolutely. Even as the instance is not so great, but the fact that portfolio diversification, the importance of hedging, because uncertainties or wars or weathers don't inform and come. So it really is imperative that you are hedged. And as Arun said, as economies grow and as we head higher, it is important to cut your losses. It is important to have proper strategies. It also is very important to hedge the kind of portfolios that you have, important to hedge the kind of businesses that you have for that matter as well. And steel is yet another start here, an important commodity. India is the second largest one into this one, so even more important that all companies, big or small, mid-size, etc., make use of this. Thank you so much, gentlemen. Thank you so much, Arun. Thank you so much, Dhruv and Navneet, for joining us today and taking us through that conversation. We appreciate your time. Thank you.
Thanks a lot.
Thank you, everyone.
Thank you.
Thank you. Thank you.